by the council for live and subsequent broadcast via the council's internet site. Throughout the evening, there will be papers which are going to be presented. Can I ask that officers and guests who are presenting those papers please introduce themselves before speaking? Thank you. Naz, apologies for absence.
No apologies received, Chair.
Okay.
I think we have one from Councillor Williams. Thank you.
Is there any urgent business?
None reported, Chair.
Declarations of interest. Can I ask members if they have any declarations of interest or conflicts of interest to declare in relation to the business for this evening? Thank you. State that there are no declarations of interest. Deputations, petitions and presentations now.
None received, Chair.
Thank you. Minutes. We're now going on to the minutes of the meeting in March the 12th, where none of the current councillor members were part of the audit committee. So I'm going to rather rely on Riaz and Rina to say whether or not it is a fair recollection of what they call the meeting was about. Are you happy with the? Are you content with the minutes?
Yes.
Yes.
Yes. So comments was provided to Naz before. I just had one clarification point, and that was on the action tracker. So the first item is from 18th of January 2024, and it stipulates that the action is still in progress. And I was just wondering, is there any clarity as to when we're expecting that to close out? Because I know it says summer 2026. Is that to close out?
Thank you. So it is still ongoing. We are expecting it was due to finish in due to report in June, but it has been slightly delayed. So hopefully we'll be able to close that, do a full update by the point of the next meeting. Thanks.
Thank you, Darren. In relation to the minute, oh, sorry, Emily. Sorry, no.
Hi, thanks. Sorry, just very briefly, at paragraph 9, in terms of leisure centres, the service said they would implement some of the recommendations by the end of March 2026. Please, can we get an update on the recommendations and what they have already implemented and not of those recommendations? And the other thing I would just like to say, going back to that in terms of the action tracker, it doesn't really seem helpful enough for us to have an action tracker that doesn't have dates in it. It should be project managed. These are actions that are expected to happen. So maybe if we could consider how the layout is different, how we actually get dates, and then we can at least break it down into what needs to be done. So just as it's presented, so that it's useful for us as a committee to be able to actually know whether things are happening in time or not happening in time. But a narrative response doesn't really seem adequate, to be honest. It's got nothing. It's just too flimsy, especially as you said, it's just been going on since 24. We're now in 26, 2 years later, and it's still just a narrative tracker. What's supposed to be.
Minesh, Minesh and I actually talked about the action tracker yesterday, covered exactly that point. I think one of the issues is that these items have been around, and what I would like to see at the very least is ideally progress, but if not progress, then a plan with timelines on it, which indicates that something is going to happen and by when. But Minesh, would you like to pick up the rest of that then?
Thank you, Chair. I think you've picked up the main point, and Councillor Carlin will take away your suggestion and build on the existing tracker to include the dates. Yeah.
Okay. On the minutes as well, on item 6 and item 7, there are a couple of items which refer to a paper that is going to be submitted to the committee. Minesh, can you give us an update as to where we are with those?
Thank you, Chair. So On the action tracker, we've spotted that there are a couple of actions that need to be added from the minutes of the last meeting. So Naz and I will pick those up and add them to the plan. And then of the remaining actions, there are a couple of actions which have now been classed as closed. And I'd welcome your input as a committee just to take them off the table for the next meeting. I think that I'll just stay there.
Thank you, Minesh. I think if you could give us an update once you've had a chance to look through those and contact the people who are concerned so that we can see if we are going to be able to get progress on at least getting plans for plans.
Thank you, Chair. That's a useful suggestion, and I'll make sure that I get an email to the committee with updated dates.
Thank you. Any other comments or questions on the minutes of the action tracker? Okay. In that case, we'll move on to item 7, which is the KPMG audit plan. And Tim Cutler is not able to be with us tonight because he is on a sabbatical. My time at KPMG, we didn't have such things. How life has changed. But we have Josh, and I believe Chris is on the Teams, and Richard are here tonight to take us through the plan. I pass across to Josh.
Yeah, thank you. So conscious there are a lot of new faces since we've attended recent audit committees over the last few years. So we'll start with introductions and then we'll jump into our report. So my name is Josh Parkinson. I'm an external audit manager at KPMG, been at the firm for almost 8 years, working across a range of different sectors, healthcare, housing, education, and now local government. And I've been involved in the Haringey Council audit since we took it on in 23-24.
Hi, I am Richard Young. I am an assistant manager working at the firm for about 5 years, and this is the second year I've been on the Haringey audit.
Hello there. My name's Chris Paisley. I believe I've met a couple of you, but I'm an external audit director at KPMG, supporting Tim in leading the audit, and I'm here in his stead tonight, as he is, as you say, on sabbatical. Josh is going to take us through the paper, but I'm obviously on hand if there's any questions that I need to answer in relation to the plan. Thank you.
Thank you. So what we've brought today is our external audit plan for the 25-26 financial year. So from 1st of April 25 to 31st of March 26. I'm aware that Tim, the audit partner, did present some content to members in terms of the role of external audit in local government. So I'll try not to repeat that too much, but do feel free to ask anything if you're unsure. We will pause for questions after each section that we go through. So for the purposes of tonight, we'll focus on what we see as the key areas of the audit plan. So the first bit being the financial statements audit, which Richard will take you through in a moment. This is our plan for giving you as the audit committee assurance over the numbers that go into the financial statements, and the draft version of those accounts is next item on the agenda, which finance will present. Under the code of audit practice, as well as the financial statements audit, we also do what's known as the value for money audit, which looks at the way in which the council ensures it uses its resources effectively. So the second area of our report, which I'll be taking you through, is our initial value for money risk assessment work. The third bit is then our assessment over building back assurance, which I will also take you through. So to start off then, I'll hand you over to Richard for the financial statement section.
Thanks, Josh. So I will be focusing on the financial statements section of the audit plan, starting with materiality, which is on slide 4. Materiality is a financial value set using auditor judgment and is a concept where any misstatements above this threshold could have an impact on the decision making of the readers of the accounts. Auditing standards require us to set materiality at a range between 0.5 to 3% of the selected benchmark, and we have set it at 2% of expenditure, which is 27 million of the group and 26.4 million for the council. We have also set performance materiality for at 17.5 million, which is a lower threshold we use for designing audit procedures to allow us to detect misstatements in aggregation that could approach materiality. We will report any individual misstatements greater than 1.08 million to this committee, which is our audit misstatement posting threshold. This is a large and complex audit, and on the next slide, we have detailed the KPMG teams we have assisting us. So there is the IT audit team who will be assessing your financial systems, the Pensions Centre of Excellence who will be performing all the work relating to pensions, such as reviewing the assumptions used. Our revaluation team, comprised of chartered surveyors, will assist on assessing the revaluation on land and buildings, especially specifically Alexandra Palace, which is a large, unique asset. And we have the data analytics team who will be helping us analyze the journals posted during the year. So the next slide is on significant risks. We are required by auditing standards to assess and identify what are known as significant risks. These are risk areas that require additional auditor focus and effort, and we design audit procedures to address them. So for this audit, we have identified 3 significant risks. The first risk we've identified is the valuation of land and buildings on slide 7. The council has around over 3.1 billion worth of land and buildings in their balance sheet, which is highly material. The valuation of these assets involve assumptions where a slight change can result in a material adjustment in the valuation. The sensitivity of these assumptions is why we've assessed it as a significant risk. Within the land and buildings is 1.8 billion worth of council dwellings. We flag on this slide that we ran into issues during last year's audit, as we were unsatisfied with the accuracy of the information. The council will need to look into this in order for us to be able to conclude on this year's audit. Next, we have the management override of controls on slide 9. This is a mandatory significant risk relating to the management's position to perpetrate fraud by bypassing financial controls, but we haven't identified anything to suggest that Haringey is a high risk of this. But we do have to identify this as a significant risk, and we will perform procedures to address this. Our third significant risk is on slide 10, which is the valuation of pension liabilities on the local government pension scheme for all council corporate staff, which currently has a present value of obligation of over 1.5 billion. So similar to the valuation of land and buildings, this valuation can be materially impacted by the assumptions used. And again, due to the sensitivity of these assumptions, we have assessed it as a significant risk. So next on slide 12, revenue revenue is a presumed significant risk for all audits, but we have rebutted this risk on the basis of the simple and predictable nature of the council's revenue streams. I won't go into the individual revenue streams now, but they are detailed on this slide. And finally, on slide 13, it includes our mandatory communications that we will make to this committee, including the statutory recommendation raised by us. But this is a later item on the agenda, so we won't be covering it here. I'll now hand over to Josh to talk about value for money.
Just as a pause there, I suppose, does anybody have any questions? I appreciate that's quite a good point to stop before we get into the value for money audit, which is very different.
Particularly on the value of property, there is obviously significant large assets which are historic and of significant value. How are you disaggregating the more sensitive smaller properties from the larger?
Yeah, so we've actually got We've actually got two slides on the valuation of land and buildings, significant risk. So the second one is focused, is it the second one? Second one is about the rolling valuation and the indexation. So for the 1.6 billion, I think it was, that Richard mentioned for council dwellings, where you've got 16,000 council houses, all quite low value, but very high volume. They are valued on a different valuation basis. So that's the existing use value social housing method, which is a different valuation basis to how you would value things like schools in the borough, which will be done on direct replacement cost. Sorry, on existing use value, or you'll have other assets at direct replacement cost. So you will have three different valuation methods effectively for different assets. And we will, I suppose, test them all differently depending on the underlying assumptions that go into them.
Any related questions on this topic?
It's probably less for yourself, but just more of a learning for the executive team. I noted the sort of significant high level of aggregation risk associated with specific responsible persons, so the deputy chief accountant. And I was wondering what mitigations have been put in place and what learnings have manifested that ensure that that risk will be managed accordingly going forward.
Thank you. Josh, do you?
Yeah, so there are a wide range of factors that go into assessing performance reality and the aggregation risk. One of which has been history of misstatements, which is probably from our side a larger driver than necessarily turnover in staff. I mean, from our side, the more senior staff have been retained and there is continuity there. We've mentioned that as it was our key contact in the previous year. But for us, it's more around, I suppose, the years in the disclaimed period where you've just got that sort of lack of audit challenge going back a few years. And what that's meant is that as we've come back into the audit, we've had a higher number of control deficiencies raised, a higher number of misstatements than normal. And for us, there just is naturally an inherent higher risk of aggregation. So I suppose from that side, there isn't as much that can be mitigated from management's point of view. That's more our assessment of where things are currently.
Are there any? Councillor Carlin.
I just wondered how you chose. I know obviously there are a number of risks where you've said that they are quantifiable, but I was wondering how you chose the three that you chose in terms of valuation of buildings management, overriding controls and pension. Is this because just how did you actually make the decision that those were the
So the mandatory override of controls, as Richard mentioned, is mandatory. We have to have that on every single audit. So that appears there. The other two are primarily based on value. And as Richard mentioned, the fact that any small change in one of the underlying assumptions will have a very large impact and will immediately cause a material misstatement over the entire population. So something like land and buildings, if you are assuming a useful life for a building of 50 years versus 49, if you're extrapolating that across thousands and thousands of assets, you will cause a material misstatement there. Similarly, on the valuation of the pension assets, the pension liabilities, sorry, if you were to change the assumed mortality rate of the people that you're paying out the benefits to, or if you were to change inflation rates in your projections, you will instantly have a very, very large impact upon the numbers. So that is primarily our driver.
If I can just add to that answer, Josh, I think inherent in that question is also why not other areas, and I think just to kind of give some context to how that decision making process goes, risk assessment, planning and risk assessment is a big part of the audit and probably takes up conservatively sort of 25 to 30% of the hours invested in the audit. So as part of our planning and risk assessment, one of the things we do is go through every single account within every single account caption within the accounts and undertake a detailed risk assessment as to the inherent risk factors that might contribute to a material misstatement, either due to fraud or error. And as a result of that, each caption within the accounts and each risk pertaining to those captions is given a rating, a score, from significant, as we have here, right through to what we call a risk of misstatement, where we effectively consider there to be not even a reasonable possibility of material misstatement, and there's a real spectrum there. That's then discussed as part of a risk and planning discussion with the full team, and it's reviewed obviously by the manager and the engagement partner. So there's that sort of process that sits behind this. It's almost like a filtration process, and you get to the point here where we have these significant risks that we're presenting to you. Those are the ones that we've, having gone through that process, we've considered to be the most significant risks of material misstatement.
Yeah. I mean, I take it from there that apart from things like management override, which is a requirement for the auditing standards anyway for every audit, the other two effectively are determined on an objective basis rather than we are seeking the top 2 or 3 or 4 items. I'm just going to mention those. So it could be a larger number if the assessment came out that way. Yep.
Yeah, exactly that. On other audits, we may have significant risks over things with significantly smaller values. Just depends on everything that goes into it and the risk assessment process that Chris has described.
Thank you. Can we move on to the VFM? Yep. Okay.
Fine. So yeah, so the second bit of the document is the value for money work, which starts on page 15, which covers 3 domains. So you've got financial sustainability, which is how the council manages its resources to ensure it can continue to deliver services. You've got governance, which is how the council ensures it makes informed decisions and manages risk. And then you've got economy, efficiency and effectiveness, which is how the council uses cost and performance metrics to improve the way it manages its services. So the way our value for money reporting works is that we produce our initial risk assessment at the planning stage of the audit, which is what we've got here. This identifies potential significant risks in arrangements to achieving value for money. As part of our final reporting, which we'll bring back at the draft version at the November audit committee, and then a final version in January, we report back on the further procedures that we will do between now and that date to identify whether or not those risks translate into what's known as significant weaknesses in arrangements during the year. And if they did, then we will also set out our recommendations to address these. It's also worth clarifying the value for money work is done on the same time frame as the financial statements audit. So what you've got before you is us assessing the arrangements in place from 1st of April 25 to 31st of March 2026. So we have identified 5 significant risks at this stage, which could impact the council's ability to achieve value for money, VFM as we call it. So 2 linked to budget setting and cost saving, which impacts financial sustainability, that domain. And then 3 linked to improving economy, efficiency and effectiveness. And these are around procurement, commercial property and adult social care. So there's a lot of detail in our risk assessment. There's a lot of slides there and a lot of content. So I'll give you a summary of each of the risks that we've identified, but happy to take any questions or anything that I don't mention or anything that I do say. So starting with the financial risks. So ultimately the overspending year is what's driving this significant risk linked to budget setting. The council did include around £40 million to combat financial pressures, mainly linked to adult social care, children's and temporary accommodation. But given how quickly the financial position deteriorated, so with the general fund being forecast to be £34 million overspent by Q1, we're not satisfied that the budget setting arrangements accurately captured and reflected all of those underlying pressures. The council also had to rely on £37 million of exceptional financial support, known as EFS, which had to be borrowed from central government in order to actually set the balanced budget for 25-26. And it then had to request an increase to this amount during the year due to these financial pressures, and then got approval for up to 54 million, I believe, if it needed it to close the accounts. So in terms of saving schemes, we can see that the council had identified £29 million of savings for 25-26 as part of that budget setting process. However, we've included a table that illustrates that by Q1, around half of these were amber or red RAG rated already, and £9 million were forecast as not being deliverable, which ultimately puts more pressure on that general fund budget. In particular, the council struggled to deliver cross-cutting savings that it had planned, which are schemes that will impact across multiple different directorates and service lines in the council. and there was around £6 million that remained unidentified throughout the year and not allocated to a specific scheme. Given how quickly the savings programme deteriorated in year and the large changes every quarter in forecast delivery and outturn, this led to us identifying this significant risk, specifically on saving schemes. The next one then is procurement. This is a historic issue that we've brought to this committee before, that we flagged in the 23-24 and 24-25 value for money work. And it's long since been the council's plan to resolve a lot of these issues through the implementation of a new procurement system. However, this is yet to take place. In the meantime, we've noted that during 25-26, there are a lot of manual processes in place, and we've commented on the lack of effective contract monitoring. Though it is worth saying that we have seen large improvements to the amount of data being collected from different services and analysed and what that data is used for since we started doing this work and became the council's auditors. Overall, we've seen from our inquiries and inspection of key documents that there has been a lot of changes made within procurement to try and improve process. For instance, we know that there was the new Procurement Act, which came in PA 23, which came in February 25, so just before the year. And the council has updated its contract standing orders to align them with this new act. There's also been the formation of the new commissioning board and efforts to improve the means by which contracts are monitored. However, the impact of all of these is still limited by that lack of a software solution, and it's challenging for the service to get engagement from all of the different service lines across the council, which is why we continue to raise a significant risk over this area. The next one then is commercial property. Again, this is carried forward from 23-24 and 24-25. Essentially, we don't believe that there are effective processes in place or appropriate oversight of commercial leases. So this affects the council's return on investment through lost rental income, through not serving rental increases or not effectively collecting arrears, but also through things like potential compliance issues through health and safety or doing repairs in a timely manner. It's just having that oversight and awareness of lease responsibilities. The processes that we've seen by the service are very manual in nature. There's a large backlog of properties due for rent reviews, and there are a very small amount of reviews and lease renewals taking place each year to try and address this backlog, which we do note in the reporting would be very beneficial because there is a large jump in rental value whenever these renewals are done, partly because of how historic some of these rolling contracts are. There are also issues in commercial property with collecting the arrears from the largest debtors. So the council has, the service has difficulties in obtaining accurate data in terms of the debtors in commercial property. So instead, they focus on the largest 20, seeing as trying to focus on the largest ones first. However, these have increased since last year from 1.8 million to 2.5 million now owed. Similar to procurement, we believe that a system solution again would help to address risk in this area and just automate a lot of the processes. And the service is in the process of creating a property review and creating a business case for that. But until this is implemented, this again will likely be retained as a significant risk and probably a significant weakness when we get there in our final reporting. So the final risk we identify then is linked to adult social care. Again, this is partially driven by the overspend in year and the delays in undertaking what's known as financial assessments. So this determines how much someone should be contributing financially towards their costs of care when they can afford to do so. So we found in the 24-25 audit that there was a large backlog, which meant that the council has begun providing care to a lot of people who could afford to contribute and will do once the assessment is made. But in the meantime, not billing for them, and then that creates a large amount of arrears. We do know there's been a lot of work done to address this, and the backlog that we'd previously looked at had halved by we got to January this year, January 26. But because the council had got through that backlog and made a lot of those assessments, it then meant that the debtors position had gone up from around 10.7 to just over 15 million because they'd got through all more assessments to then know that more people then owed money towards the costs of care. We also draw out here commentary from the CQC inspection by an external body on adult social care, which gave a requires improvement rating, again, just before 25-26, as well as a report from the local government social care ombudsman, which was published in November 25 and highlighted issues with historic practices relating to unread emails in the social care mailbox. So whilst we were happy with the response from management in terms of that, and there was a social care action plan that came to an audit, I think it went to cabinet and to audit committee back end of last year. We are continuing to monitor the council's response to the CQC report through this action plan and future reporting. So I think in terms of VFM, that sort of covers the 5 main areas in a brief summary. Happy to take questions there before I go on to the build back.
Questions for KPMG on VFM work? Councillor Williams.
So that is investment property held for obviously commercial return. So you primarily is you've got shops and land are the two largest and units. You've got commercial units. They are split out in the financial statements in the investment property notes. So there is a breakdown in there.
Councillor Carlin.
I just wondered, the figures that you're giving in terms of financial risk are based on Q3 and so do you take into consideration when you're doing the value for money that the difference in the outturn from Q3, and how do you deal with that?
Yeah, so I suppose it's worth noting, I guess it's part of the process of how we do the value for money work, that this is just a risk assessment. This is not our final conclusion and findings. As at right in this report, Q3 was the data that we had. Q4 will be post year end with the accounts having been finalised 30th of June. So the Q4 reports weren't available at the time of writing. When we come back with our final reporting, we will include further figures for Q4 and how that then reflected in the final figures, yes.
Are there further questions? Okay. I have one which is in relation to the savings. When it comes to the saving, will you be looking at how sticky those savings are in the sense of their ability to be recurring year on year versus one-offs that will therefore need to be replaced and added into the current year's targets?
Yeah, I suppose on the specific detail of the savings, it might be helpful possibly to defer to finance. I suppose we do note in here about the cross-cutting savings, which would be those long-term gains that were quite difficult to achieve. But I think if Taryn, it might be helpful to come in on the detail on that.
Yeah, thank you. So looking at both the 25-26 and also the 26-27 savings, they are all assumed to be recurring. What I would say, however, and you will see this in the 25-26 outturn report that went to Cabinet last week, is that some of the achievement of the savings in 25-26 have been through one-off mitigation, i.e. holding vacancies or additional income. But when we set the savings, they are, I've just double checked, they are all assumed to be recurring. But as I say, sometimes then only achieved as one-offs, which means that, well, either that one-off needs to be achieved the following year, or ideally they would be realised as ongoing savings.
Thank you, Taryn. Councillor Fitzgerald.
This one is more for officers actually, but there is mention of in the value for money work about the need that the council's had to update its damp and mold policy in response to the introduction of AWAB's law. And we know that obviously there can be costs to the council when they're forced to pay out compensation to their tenants. I just wonder, has there been any assessment done of the current rate of non-compliance with AWAB's law and the potential cost of that rate, and also the potential future cost to the council for any future failure to comply with the law?
So apologies. So the answer is yes. So we have done some estimates of both, well, the costs that we're incurring now, but also future. I just haven't got the detail, I'm afraid. So I would need to go back to the service to find that through. So if it's okay, we'll either circulate it with the actions or with the minutes, or we can circulate it around to the committee after.
Thank you, Taryn. Are there any further questions? Okay, Josh, would you like to?
Yeah, so the final section begins on page 43 of our report, which I appreciate is quite technical, so feel free to ask any questions. So this is around the building back assurance risk assessment. So I believe Tim did cover some of the background on this and the backlog in auditing in the previous session that he's run. But effectively, Haringey has had 3 years under the previous auditors with a disclaimed opinion. So you've got no assurance at all given over the financial statements from April 2020 to March 2023. So we are slowly trying to do what's known as that building back assurance over a number of years. So our first step is to get to a point where we can successfully audit all of the in-year income and expenditure that goes through in a given year, and then also to get assurance over the closing position of the balance sheet, so creditors, debtors, investments, borrowings, and asset valuations. The problem then, and what the rebuilding assurance is aimed at, is how to get assurance over the council's reserves. So as to get to the current reserves position, effectively you would need to start back at the last audited position in 31st of March 2020. And then, for example, something like the general fund, you've got all of the income and expenditure movements from that period moving forward that flow in through that general fund reserve. Similarly, for something like the revaluation reserve, you will have all of the asset revaluations in that intervening period that then flow into the revaluation reserve. So we are required by MHCLG to set out our approach to building back assurance over reserves by 31st of July, both to this committee, which is what we're doing now, and then in a separate return for all local government bodies direct to MHCLG. So they've created 4 categories, which are listed on page 46, and which each local authority will fall into. And for Haringey, based on our risk assessment work, we've opted for category C, which effectively, to summarise, is saying that yes, the build-back assurance work is technically possible based on what we've seen in the risk assessment we've done. However, we think there are significant practical and technical challenges that we would face that make this unlikely to happen by MHCLG's current proposed deadline of the 27-28 financial year. You'll see then on page 47 and 48, is it? No, sorry, before that, on 43 and 44, we set out the specific procedures that we'll need to do. So as I talked about those movements in the general fund reserve for income and expenditure, we then, because of the amount of movement that's happened in the intervening period, our risk assessment approach has then said that we will need to go back and substantively test income and expenditure during those 3 years. Similarly, on revaluation reserve, we would need to test the valuation reports. We would need to look at capital additions during the period and tie those back to supporting evidence. We also flag here that we were aware of a historical fraud that occurred during 23-24. And whilst we're happy this doesn't have a material impact on our audits moving forward, this did take a significant amount of work from internal audit to investigate alongside Mazars to get us to that point. And we would need this work to be repeated for those 3 disclaimed periods, as effectively the conditions that allowed that fraud to occur were still present in those previous periods. So I suppose what we have aimed to set out here is to show that there are a number of different practical and technical challenges I mentioned. Although all of this work in isolation is possible, in reality, we don't think it's likely to occur. Haringey aren't the only category C council we have, and we do have some in category D, which is effectively that there is no chance that we could possibly get to the point of rebuilding assurance. And the purpose of the MHCLG return that we're doing at the end of this month is so that they can assess the scale of the problem, how many authorities fall into each category, and what they need to do then to allow authorities to move on from these legacy audit issues. So this may take the form of statutory override possibly down the line, which would effectively restart your clock on reserves. But we don't know at this stage what their approach will look like, so we wouldn't second guess. But at this stage, we are reporting sort of the position as best we can. Happy to take any questions on the build back, if anybody's got anything.
Any questions on the build back assurance? Yes.
Thanks, Chair. So Josh, I guess just in a nutshell, you're saying that I guess this committee and the council can expect disclaimer opinions between now and the end of your tenure. We can expect disclaimer opinions on the audits for the financial audit.
Effectively, yes, because we believe that the effect of the reserves is pervasive on the rest of the accounts. So yes, we can. It's worth saying that we still are doing significant audit work and getting. I suppose we are doing work over those balances to give assurance to this committee. What we're not doing then is giving that opinion at the end because of the pervasiveness of the effect of the reserves. So until you then have that action, either we do the build back assessment or the build back work, sorry, or we have that action from MHCLG, yes.
All right, so, sorry, Chair, if I may. So between now and 27, 28, do we have a sense of the key balances we would get assurance on?
So we've already tested, so I suppose 24, 25 as an example, we tested all of the in-year income, in-year expenditure, except for the movements in things like releases of debtors that then impacts into your income and expenditure. We tested the closing debtor position, closing creditor position, all of cash and investments, all of investment property, all of land and buildings except for council dwellings, which I appreciate is quite a large balance, but that was due to a specific issue in the underlying data that we mentioned earlier. So we have covered a lot of the top end of the balance sheet. It is just those reserves that will continue to be an issue.
A question, Josh. When I spoke with Tim, we did talk about the building back assurance process at a high level. I do have outstanding questions on each one of the pieces of work which are proposed as to what their scope, their extent, and the outcome of those is going to be, and therefore their contribution towards building back assurance. And it's something which I anticipate taking up with him when he's back in September. But just as a side question, when you're doing this work on building back assurance, is that going to be done alongside the actual current year's audit work, or is it going to be a separate engagement? And could it be done, therefore, effectively at any time during the year rather than having to be done at the same time?
Yes, could be done at any time. We've produced this risk assessment work over the last few months before the draft accounts have come in. So when we're not doing the year-end audit, but yes, effectively this could be done at any time because we are looking historically. We do set out on page 45 a rough guide as to when we could, we've got a year, and then when we could get to each of these areas. But effectively, yes, we could do these at any time.
Thank you. Any further questions? Okay. Are there any comments that you'd like to make in response, further comments at all, Josh?
I mean, we are, I suppose, just as a general update on this year's audit, we've got the draft accounts as of 30th of June. We've started well. We've had a continued positive engagement from management, so we do have a good working relationship, and we are trying to address some of the issues that we flagged here in terms of things that may have stopped us getting there on previous audits. But no, hopefully continue to work well together and report back in November.
Thank you. Taryn, have you got any observations or comments? No, thank you. Okay, the recommendation that we're looking for here is that the committee notes the contents and cover report, the draft audit plan, and also contains feedback of the progress of building back assurance work and the VFM update. And that, of course, includes any further comments which you have KPMG during the meeting. Are we content with that? Thank you. We've got a change in the order in view of the linkage between KPMG's presence that we'd like to move on to item 14 next, which is to do with their statutory recommendation. So, Taryn.
Yeah, thank you, Chair, and thank you for accepting this late item of business. I'm conscious it was only published a couple of days ago. So on Monday the 20th of July, full council agreed a series of recommendations, including the first one, which is a statutory recommendation that was issued by KPMG back in May. So the statutory recommendation related to, I suppose, two main areas that I would summarise as set out in full in the report. One, it's one statutory recommendation and two non-statutory recommendations, particularly around delivery of savings and also the identification of new savings and therefore the increased reliance on exceptional financial support. What I would say is that when KPMG published their value for money report back in end of end of January, it came to this committee, there was an indication that there was a risk that a statutory recommendation would be issued. And as I say, we did formally receive that in May. We do usually, under kind of the regulations, we usually only have 28 days to pull together a full council meeting and provide a full response, which is then discussed at council. But given where we were with the election cycle, we agreed with KPMG that we would take it to the next council meeting, which, as I say, took place on the 20th of July. So you've got in the paper, so there's a short covering report that provides a summary, and then you have got the full report and appendices that were presented to council on Monday. So in summary, so council did accept recommendation 1, which was to accept the statutory recommendation from KPMG. In terms of the council's response to that recommendation, it was accepted, it was approved, but with an amendment. And the amendment was such that the council establishes a cross-party finance improvement board, which will include a representative from all 3 political groups. And so that amended recommendation was accepted at council on Monday. The third recommendation, which is of particular relevance to this committee and which was agreed, was that the ongoing monitoring and progress of our action plan that was agreed would be reported through this audit committee. It will be reported both through the annual governance statements updates, which you receive twice a year, and also I'm sure further updates from KPMG when they come back to the committee will also cover that as well. What I would also highlight is that in addition to the formal reporting to this audit committee, we will also be reporting progress through our quarterly finance reports that also go to both Cabinet and Overview and Scrutiny Committee. I'm happy to take the details set out in the report, and I'm happy to take any questions.
Thank you, Taryn. As councillors, we were all there on Monday, and the motions passed unanimously. Nonetheless, it's an opportunity to ask questions, and particularly for Riaz and Rena, if you have any questions you would like to ask about this particular item.
Question, Chair. Yeah, so my question is twofold. I've seen the response to the management response, and it basically focuses on the savings aspect quite a bit. So the one question is to KPMG about whether they're happy with the response or not. I'm not sure if you're in a position to answer that now. And the second question for management is like I said, the responses focus mainly on the savings. And I wondered why there wasn't some emphasis on or priority around plans to ensure that we collect the income that is due to us. So basically sweating the assets, realizing the value from our assets. Because we have tons of examples, or we have some examples where we can do that, and it's given real benefit.
Thank you, Riaz. Josh,
Yeah,
and then Taryn.
I suppose just on the first point, unless Chris is going to jump in because he's leading on our statutory recommendation, I would suggest too soon to have any comment back on the response, given that it was Monday when Chris was down attending.
Yeah, I think that's right, Josh. I think in terms of, sort of optically having read them, they seem reasonable responses. But it's too soon to say whether they're adequate. I suppose the evidence as to whether they're adequate will be will come later when we see what the outcomes are. So that I guess, as Josh has made clear, we'll be looking at this very closely as part of our VFM. They're inextricably linked in terms of the work that we do in response to those VFM risks, particularly the 2 financial sustainability related risks, and the outcome of this statutory recommendation process and the actions that are taken thereafter. So in the fullness of time, we will be able to express a view as to whether they are adequate and have borne fruit, as it were, in terms of reducing reliance on EFS and improving the financial sustainability of the organisation.
Thank you, Chris.
Yeah, thank you for the question. And the statutory recommendation was specifically around savings, and therefore that was the response that we provided. However, there is a wider financial planning process that takes place that picks up almost everything that we were doing in all aspects of financial management. So you picked up particularly around income generation, and we referred to it in our response, but we have developed a financial resilience plan, a 3-year plan, which is looking at 8 key priority areas, of which income and income collection is one of those, as well as each service is required to produce a value for money action plan, which essentially is also about demonstrating value for money and coming up with options in terms of how we reduce our costs and increase our income. So, you know, the response that you see today is specifically to the statutory recommendation, which is related to savings, and also the non-statutory ones, which also relate to the financial, like the culture in the organisation as well. But they are part of a wider financial resilience plan that is addressing all of the issues that we need to get us to financial sustainability. The only other thing that I would just add is that we are developing, so under each of those 8 priority areas in the financial resilience plan and all the value for money action plans for other services that are not covered by those 8 areas, there will be really detailed delivery plans under those, and that is likely to form some of the reporting that we bring into audit committee. So I appreciate it probably looks quite high level in terms of our response to full council, but we're working through the detailed action plans that will give you as a committee the assurance that we are making progress.
Yes, sorry, we've got questions. Are you happy? Yeah. Councillor Fitzgerald.
I thought this was a good time because it's a question about the finance resilience, the financial resilience plan. Firstly, I was just wondering if you could say a bit more about how those 8 key priority areas were arrived at, and also I noted that it says that the plan will probably need capacity and expertise dedicated to delivery. So effectively, we might need to spend money on the plan to save money through the plan. And I just wanted to ask, are we confident that we'll have a strong process in place for making sure any money spent on the delivery of the plan will itself be money well spent?
Thank you. Taryn?
Yeah, thank you. In terms of the 8 key priorities, I think, well, there's a couple of things that kind of have shaped that plan. One is that we've recognised that we can no longer do 1-year budget setting. We need to think across the medium term. So it is a 3-year plan. We have recognised that if you look at where we spend our money, it's predominantly those demand-led services, so adults, children's and kind of housing. So we have identified recognising that we can't do everything. I think sometimes when you try to do everything, you actually achieve nothing. And I think that's probably some of what we've experienced over the last couple of years. So we focus on 8 areas where we think there is the most potential. Most of them are the areas where we're spending most of the money, but they're also the areas where we think that there is opportunities to demonstrate better value for money. And that is not just about reducing costs and increasing income, but also, say, in the case of adults, about improving performance as well. So that was one of the drivers. One of the areas as you picked up is around income collection. You know, we've recognised that income has to be one of our key levers to try to kind of reduce that reliability on EFS. So, you know, eventually, I suspect all services will need to go through and be one of those priority areas, but we've recognised that these are the 8 areas where we think we've got most potential over the next 3 years. What I would say is, you know, all other services that aren't captured by those 8 aren't exempt from the process, and that's why we are asking them to all produce a value for money action plan, because for me it is really important that every pound that we spend, that we are demonstrating that we are it's spent in the right way and we're getting the outcomes that we expect. So that is all being taken forward over the summer as officers, and that will be coming forward through the budget planning process that will really start in September. So all of that work is happening at the moment. In terms of the particularly when you look at investors, so investor saving, prevention and early intervention, particularly in those demand-led services, is a key area for us. And we have recognised that to deliver long-term sustainable reductions will require an investor save. And so I have a corporate pot of money that I've set aside, just a small sum that I manage corporately, so that when the business cases come through, there is an allocation. Because I think, you know, we've recognised that when you try to do some of these changes as part of business as usual, it's really, really challenging. So we have recognised that. That will get great scrutiny when the business cases and the delivery plans come through. If it is agreed, we will also, and a similar question actually came up at Overview and Scrutiny Committee on Tuesday, we will be much more rigorous in the tracking and the reporting of the benefits against the investment that we've provided. So we do monitor that internally at the moment, not as strong as what we should, absolutely, but we will start to report on that more externally as well. Particularly, you know, we need to demonstrate to you as an audit committee, to members, to KPMG, and therefore we will need to put much more in our quarterly reports, and, you know, be really bold. And if something isn't delivering, then actually we need to take a step back and say, did we invest in the right place? And we shouldn't be afraid from pausing something if it's not working. We're entering into a period where, you know, we will need to try to do things quite differently.
That answer your question? Yeah. And there was Councillor Carlin.
In terms of reporting to this committee, I'm just interested in how what that reporting's going to look like. Again, is it going to be a narrative report? Is it going, how is it going to be reported, and how are we going to be able to track progress?
Yeah, so we're still working up what the reporting looks like. So I think next committee meeting is November. Thank you, Minesh. So we're still working out what that looks like, but just Councillor Carlin, to give you a bit of an assurance, just providing a narrative like we do in the action tracker won't be sufficient. So there will be detailed numbers, there will be detailed explanations. It will be much more about reporting progress against individual savings as well to this committee, which hasn't come in the past. That's largely been reported to Overview and Scrutiny Committee. So there will be some narrative, but there might be much more in terms of kind of savings tracker type documents where you can actually look at individual savings items.
Thank you. Councillor Johnston.
Sorry, just a clarification point on Finn's question. That corporate pot that you said about, is that for kind of like staffing, resourcing for these projects, or is that for like the projects themselves?
So it could be a mix. So it could be a particular service comes forward with a business case that says that they need some dedicated staffing resource just to focus on this particular project. So it could be staffing resource. It could also be expertise advice, so sector expertise that perhaps we don't have internally, and it's for one particular project. We don't want to build we want to get access to that advice immediately. So it will be an absolute mix of those. This is very much about the additional capacity or skills or expertise to deliver the project, as opposed to kind of money going into budgets, and it will be very, very closely tracked.
Rena.
Could you sort of articulate what you're doing differently in terms of delivery of savings this year versus the previous year? Because otherwise it starts to feel like sort of the kind of, sorry, words are evading me, but kind of recycling or doing the same thing and expecting a different outcome. And I just wonder, when you look and rag rate the initiatives, if you know from the onset that the likely delivery is red rated, what is the course correction or approach strategically that the council is going to take to ensure that you're either plugging that saving or you're doing something fundamentally differently?
Thank you.
Yeah, thank you. And we need to demonstrate something's different, otherwise we'll be in a similar position. So there are a couple of things that I would highlight. So we are, and we've started it this year, but started it last year. last year. Started it last year, but probably not as rigorously as we should, that we not only track the progress against the financial savings, but we track the progress much more detailed about the changes that are needed to deliver the savings. So that's one of the things that we are doing. At the planning stage, we are going to be much harsher in terms of the assurance on the delivery of savings before they get built into the budget. So what happens is savings get built into the budget gets taken away when the budget gets agreed in March each year. There will be much more scrutiny and challenge internally, but also externally, so that we're building in savings that we've got more assurance on the delivery. I suppose in the first example is kind of the monitoring of them going forward. So we get the assurance that we're only building in savings that we absolutely think we can achieve. There is always some risk, absolutely, and also being much more open and transparent about where that risk might be. I would expect on average 90 to 95% of savings to be delivered. We're currently between 60 and 65, so we're a long way from where we need to be. So it's both the greater assurance before they go into the budget, but also the greater assurance in terms of the monitoring. We will be monitoring them much more closely through the Finance Recovery Board, which is an officer group, but also that cross-party Finance Improvement Board will also be looking at the progress of the savings. We will also be holding people to account more. So one of the non-statutory recommendations that were put forward by KPMG was about the financial management culture in the organisation. So, that accountability and consequences as a result is something that internally we will be absolutely progressing and taking that forward. So there's a combination of things that we are happening. I mean, certainly from my perspective, and given that I have to recommend a budget to Cabinet to then recommend to Council, there will be much tighter scrutiny on before savings even get into the budget going forward.
Question, Taryn. From what you're saying, well, the major difference is that, well, two major differences, that we're being much more robust about looking at the quantum of savings that we think we can get in the first place. But secondly, there is the follow-on aspect that you are looking at not just the outputs, but the ways in which they're achieved to instill or reinforce a culture of financial prudence in every decision which is taken. And for that, is there any briefing which has been given to the teams beforehand to explain the kinds of behaviours and attitudes that we're looking for, and then the monitoring that will take place to see that those kinds of behaviours are actually embedding themselves?
Yeah, thank you. So we have done a lot of work over 25-26 in terms of trying to shift that culture, in terms of kind of getting, so that it's not just responsibility and accountability doesn't just sit with me in terms of the delivery, although I'm the one that is always sat here explaining it. I can't solely be responsible for making sure that we do. So we've done an awful lot of work, not just in terms of corporate director and director level, but also down to head of service level, about almost trying to get that collective ownership and shifting that culture. And I'm not going to sit here and say it's easy and we've solved it, because it is extremely hard. Some of the ways that we have had to do that and to get people to think is to put the really strict controls in place so that people can't spend money without thinking of it. And it shifts the mindset, and it starts to get people thinking. So we will carry that engagement, and that holding people to account will just need to carry on all the way through the year. I'm sure for the following year, will we ever get to where we want to get to? Who knows? But we just need to try different approaches. But I do think the holding to account and the consequences is a really important introduction for this year. And as an example, every corporate director, including myself, had to sign off their budget at the end, before the end of the year, giving that assurance that they would remain within their cash limit and they wouldn't be overspending. We need to take, so those are the more stringent, I think, approaches that we haven't done previously. Just picking up on your point around monitoring not just the savings, but also the delivery of the changes, it is twofold. One, it is to almost get some assurance that we're on track, but also if something isn't on track and it's mitigated to an alternative saving, actually what I don't want to lose is sight of that original saving, because we will still need that original saving in the following year. So there is two reasons for tracking, not just financial savings, but also the changes.
Thank you. So ideally, we'd end up in a situation where once we are back on track, behaviours have embedded themselves and so that they become enduring and they don't have to be monitored and tracked in quite the same way because they will just be part of the way that we do things around here.
I would like to hope so, Chair. I would like to hope so, because actually the actions and what we've put in place over the last year to bring that greater ownership, the controls, the governance, the additional layers of kind of approval is actually really, really resource intensive. It's just not sustainable long term, and it shouldn't be. But until I've got the assurance and kind of the senior leadership team, those will need to remain in place. But once we've got some of that assurance, then maybe we can start to ease some of those off.
Councillor Arkell.
Thank you. Thanks, Taryn, for that information. I was just wondering if you could just give a bit more detail about the scrutiny of the savings proposals before they even get presented to Cabinet. And the reason that I ask is that when you're doing service change, the timelines taken to actually deliver that change can take a lot longer from the point where you start even talking about it to getting to deliver them. Specifically, if it's around staff changes to contracts or like cultural change within a service or ways of working. So how is that going to be actually done to achieve these savings that are needed?
Yeah, thank you. And as part of so all of the work that officers are doing over the summer to develop those delivery plans, the business cases, the value for money action plans, and any opportunities that come through that, we will also need to be very realistic about the achievement of the savings. So I think in previous years, we just assumed full year effect. So your example of staffing changes, if the director of HR was sat here, he would say, actually, if you want to get the full year effect for the following year, then you need to have started those changes by October of the year before. So quite often, I think in previous years, we haven't started those changes, and yet we still assumed the full year effect. So that we will get much tighter on that. So it won't be surprising to see that any new savings that come forward, it may be a smaller amount in 27-28 before you get the full year effect in 28-29. And I think that is an improvement we need to put in place. I don't think we have done that to the extent that we should have. And it applies to the capital programme as well. I think we're always too optimistic about how quickly changes can be implemented. Plus also some changes will require consultation. And therefore, when you start, you have to factor in the timescales for that. So almost the governance and the consultation process. So when you start to see, so they will come, the proposals will come to Cabinet in November to essentially request permission to go out to consult, including through members, but also externally with residents and other stakeholders as well. That timing of the delivery of savings will need to be captured as part of that.
And Councillor Carlin.
My favourite, capital isn't on the list, and so what, as we know, if we can reduce our capital as much as possible, reduce our borrowing as much as possible, that reduces the need for us to increase the envelope in future years, and it is the most effective way to make £1 million worth of cuts is huge. To avoid £1 million worth of interest can be done. And so what are we doing on capital to drive down, not talking about big capital projects, I'm talking about capitalization, I'm talking about the entire capital envelope across the council.
Thank you. So capital, review and reduction, I'm going to say, of the capital programme is one of the 8 priority areas in the financial resilience plan. So, we've talked about savings here because that is the response to the particular aspects of the statutory recommendation. But just to give you some assurance, Councillor Carlin, that is one of the 8 priorities. That work has started. So I'm keeping officers across the council extremely busy over the summer period. So not only are they looking at all of their revenue options, we are doing a more detailed. So we do an annual review. We have done for the last 2 years of the capital programme, but much tighter this year in the sense that we're reviewing every single scheme, and if it hasn't started or it could be paused, then we are looking at those opportunities, particularly at a time when interest rates are remaining kind of stubbornly high. So we are doing that piece of work. So the proposals that come up in the autumn will also include any proposed changes to the capital programme. The other thing that we are doing as part of that, which I think is important to give this committee the assurance, is that we introduced a new governance process around the capital programme about a year ago now. So every new scheme doesn't go in the capital programme until it's gone through a series of kind of gateway approvals from, you know, outline business case right through to full business case before it actually goes in. Because I think, you know, like many authorities, quite often we build things into the programme too early. So we're doing that for all new schemes, and we have been doing that last year as well. But we have still got some schemes that have been in the capital programme for a number of years. So we are applying that governance process retrospectively to those schemes as part of the work that we're doing over the summer to look exactly, you know, and also going back to original business cases and what those assumptions are and testing those. So there's quite a significant and very detailed piece of work on the capital programme.
Any further questions? Thank you. KPMG, have you got any comments on anything that you've heard? Thank you. In that case, we'll move to the recommendation, which is that the Audit Committee is asked to note that on 20th of July 2026, full council accepted the statutory recommendation and non-statutory recommendations presented by KPMG LLP and approved with amendment the actions in response to this statutory recommendation and non-statutory recommendations that are set out in Appendix C, and delegated the monitoring of the delivery of the actions through the regular reporting of the annual governance statement and action plan to the Audit Committee. Are we content to note? Thank you. Okay, to Josh, Richard, Chris, you're very welcome to stay if that's what you would like to do. You're equally, I think we probably covered the areas where your involvement and your participation is central to what we're discussing. So if you would like to leave, then that will be fine too. Okay, thank you. We'll now move on to item 8, which I think is going to be introduced by Casey.
Thanks, Chair. Good evening, members of the Audit Committee and colleagues. My name is Casey Kebu. I'm the Chief Accountant of Haringey. The next report is the Statement of Accounts. As a local authority, we are required to publish a draft Statement of Accounts by the 30th of June. That's by the amended regulation of 2024. And also following that, there's a period of public inspection. So we published on time, and we're in the period of public inspection. That's a 30-day period where members of the public can come in to inspect the accounts or can make observations and commentaries to the accounts by writing to us. So we have the details in the Statement of Accounts for people to contact us. So that period will end on the 11th of August, Tuesday, 11th of August, 2026. The Statement of Accounts, it's basically a highlight of the performances of the council, financial performance of the council from April 2025 to 31st March 2026. But I would say it's much more than that. If you look at our Statement of Account, the way we structured it, it starts with narratives to the statements, which gives you much more than financial performance. It tells you about our other achievements within the borough in that period of time. It gives you a forward outlook of Haringey and as a council, what we are planning to do and measures we're taking. And after that, you have the core statements of accounts. So these are the aspects of the statement of account we're presenting to you. You have the core statements, which is a comprehensive income and expenditure statement, which is more like what you call the profit and loss account in the private sector. You have the balance sheets, and you have the movement in reserves. you have the cash flow, and then we have all other statements. We call them supplementary statements. That's the housing revenue account and the collection fund account. And finally, we have the AGS, annual governance statements. So this form the part of the whole bundle that you have there with you. We are here for you to note the statement of accounts, provide comments, observations on the statement of accounts. It's still a draft at this stage. It's going through audit at the moment. So we'll take in all those observations and commentary and then come back with a final account sometime in January after the audit to present to you. Thank you very much.
Thank you, Casey. Bearing in mind that we have the AGS as a completely separate agenda item, item 9, are there questions for Casey and for Taryn in relation to anything in the draft statement of accounts that we had circulated earlier, including the narrative, introduction, as well as the accounts and supplementary accounts? No. Okay.
It's just on the narrative and the reading of the content, considering the audience of this document. We mentioned the statutory recommendation once or twice in narrative, but there's no real explanation of what that means. And I think as a layperson reading the accounts, I'm not sure that will make any sense to them. It's just something we can look at.
Just to come back briefly on that, so this was published on the 30th of, so I did mention it and I ummed and ahed about mentioning it, if I can be perfectly honest, because these were published on the 30th of June and full council wasn't until the 20th of July. So I did highlight it, took a little bit of a risk, but I think perhaps in the final version of the accounts that come forward, you know, we will be a further 4 or 5 months on. I do think we should now expand on that, but it wouldn't have been correct at that time for me to say anymore.
So we anticipate that the narrative at least is going to be expanded to cover these points and other matters. Given that we know that the narrative has got room for expansion, are there any other thoughts or questions on matters that you think we could? Councillor Clark.
It kind of builds on items that you raised earlier, Taryn, that Councillor Arkell did, that evidently we're in a situation where we're going to have to think laterally here. How are ideas between services and efficiencies laterally across the council being considered and tracked? Question, are the efficiency, you know, the actions being looked at in isolation within services, and are there efficiencies across the board that we could be looking at?
Yeah, so sorry, Chair. Sorry. The answer is we need to look at both. So I don't think we've yet got the assurance that even when we look into individual services that we're, you know, everything is offering best value for money, and we've identified all those opportunities. So we do need to absolutely do that piece of work, and that's probably the drivers for the value for money action plan. However, given the savings that we've delivered in the past and the reductions that we've made, the level of savings, if we just take that approach, isn't going to come anywhere close, or, you know, kind of to where we need to be. So we do need to look across services. I mean, I've answered this question once this week actually, so it must have been at another committee as well. You know, we can't be constrained by service boundaries. You know, my view is the customer, the resident, it's the council, isn't it? It's the customer journey, and that is what we have got to look at. So we do need to look. That is where I think we will find the more significant ideas about doing things differently. And I can give you some examples of a particular project where I'm kind of the sponsor, and actually it's 6 different services across 3 different directorates that are working together on an adult social care piece of work, and that is how you drive out, because we're looking at that whole customer journey. So it is a bit of both. What I would say, however, is when you look, and it was highlighted by KPMG, the delivery of the cost-cutting savings is always the most difficult. So if you look at a savings tracker for last year, for example, most services delivered their service savings almost in full. You know, a lot of them did, very, very high level of achievement. Where we really struggle, where we need to do something differently, is the cross-cutting, because that for me is where the potential is.
And just coming back on that, I think, Chair, referring to the risk register, the loss of capability within the organisation to deliver capacity change is a significant risk, and I have a particular concern noting, you know, what points the auditor have made, concerns Taryn has raised, but also the way that the lack of organizational capability to deliver major transformational change is being degraded, that we're actually biggest savings, the biggest areas for improvement are the areas that we are actually least capable of targeting, and you know, the spent that risk, I feel, is something that we need to focus on within this committee.
We're certainly going to be coming along to the risk matrix, and that question is one which I think is pervasive across a number of the agenda items, because actually to deliver anything that we're wanting to do here, it is all about making a quite fundamental change in the way that people think about what they are doing. But Taryn, if you've got some further thoughts on that.
I suppose all I was going to say is that we recognise that you need to deliver this, you have to put additional capacity, skills, and there was one other, but it slipped my mind now. Capacity, skills, but also ownership. So, you know, quite often with the cross-cutting savings, it could be, say, one of the corporate directors, you know, the corporate directors like myself that's leading it, but it's impacting on every single, could be impacting on more than one service across the organisation. So where we need to shift to be able to deliver those cross-cutting is that those cross-cutting savings are not my responsibility, or there's another corporate director that's leading a couple of those other cross-cutting ones, but actually it's an overall kind of corporate leadership team responsibility in terms of the delivery. And I think that's one of the things that we perhaps haven't got quite right in last year, which we need to shift for this year going forward.
Councillor Carlin, you had a question?
As you just said, we haven't got that right. You know, we've noted that the cross-cutting didn't deliver the savings. We know that there's a lack of capacity. We know that there's been an inability of the organisation to actually deliver. So what's going to be different? And you know, we could get to the end of this financial year and be in a similar. What's going to actually change? Are we talking about getting in external, you know, external assistance? How are we going to actually do it to change the narrative?
Yeah, so I think we've recognised, I think in the past we've tried to do too many things as part of business as usual alongside the day job. And if I can be perfectly honest, it's not sustainable. Things like this will always go to the bottom of the priority list. And so, you know, that separate allocation that I've set aside that I will manage and I will control, and people need to put requests in, is recognising that we can't do this without that additional investment or expertise. But I still come back to the ownership and accountability. It almost comes back to the culture and the behaviours. That is the area that we also need to address in 26, or strengthen in 26, 27, particularly on the cross-cutting ones.
I think, yeah, Rena.
Just a point of clarification on the cross-cutting and savings initiatives. How do you ensure that the behaviours that manifest? I know you spoke about the kind of corporate leadership and corporate ownership, but my own sort of personal experience said people become very territorial about their services. So how do you ensure that the behaviours don't sort of, kind of bleed into the way that savings are considered, and that actually this enterprise first approach is actually taken.
Councillor Johnson, were you wanting to ask a question, and was it related to the same topic? Yeah. Okay, thank you. I think we keep coming back to this question. And I think it's something that we'd all love to know and see an answer to. My experience is there is no quick answer to this. It takes a lot of time. It takes a lot of planning. And I'd like to think that perhaps we can leave Taryn and her team to get on with what they're doing and perhaps come back to the next committee meeting and talk to us about the progress that's been made, particularly along the lines of process and also the outcomes which have been delivered. Is that fair, Taryn? Sure.
One thing, in addition to like cross-directorate savings, is there any work being done on like cross-borough work to kind of like improve like purchasing power and reduce costs in that way?
Yeah, so what I would say is we've got to look at everything, including, I think the really good example is particularly within adult social care, so across the NCL, the North Central London group, might be opportunities for shared services. There might be, our financial position says we need to look at all of those options, to be honest.
Thank you. Are we any further questions on the draft statement of accounts? Okay. In that case, the recommendation is that the committee notes the contents of this report and the appended draft statement of account. Do we agree? Yep. Thank you. Okay, we'll move. You're done now. You're not able to stay for the AGS. Okay. Thank you very much indeed. Thank you. And we'll see you later in the year. Right, we'll move on to agenda item 9, which is the draft annual governance statement, which has been prepared by Fiona, I think. Taryn, but you're leading on this one.
Yes, thank you, Chair, and apologies from Fiona, who's our monitoring officer, who is the author of this report and the annual governance statement. So before you tonight is the annual governance statement, which is published as part of the accounts, but we have pulled it out as a separate agenda item. It is published each year. It is signed by the Chief Executive and the leader, and it is also considered by the Audit Committee. In terms of the annual governance statement itself, so I'll run through a couple of the key themes in a minute, but just to say this is the statement for 25-26, but we do also report progress twice through the year on the issues identified both in the previous years, but also if there's any issues emerging. So as I say, from this year, so in the past it would have been prepared by the head of internal audit, but a change in guidance from this year, it's prepared by the monitoring officer, and it uses a range of information, including the director's assurance statements, the outcomes of both internal reviews, external audit findings, and recent other external reviews and inspections. But the director's assurance statements are a really key source of information that the monitoring officer will use to prepare it. It is prepared in line with a series of guidance, which is set out in section 6 of the report on page 264. So it's quite prescriptive in terms of what we need to include in the statement. In terms of the key findings that I would just flag to you today, so if you look on page 265, it has highlighted 6 areas that have been flagged as areas in this particular report this year. So the first is around financial, and I should say you will notice, which you would expect to see, you will notice some similarities with some of the issues that KPMG have just reported in their value for money risk assessment. I would almost be concerned if there wasn't that similarity, but just so the committee are aware. So there are 6 main areas that have been flagged. One is around financial sustainability, which we have just covered under the last couple of items. The second is around asset management, so commercial property, but also wider asset management and including the operational estate. The third, which wasn't necessarily picked up by KPMG, is the housing improvement programme, which is on the back of the inspection that we had a couple of years ago. Also highlighted is the high levels of, sorry, I'm on page 265 of your pack at the moment. The next area that's been highlighted is the high levels of freedom of information requests, subject access requests, and in particular, the timescales in which we respond and the feedback from the Ombudsman. And then the final area that has been highlighted, consistent final 2 areas consistent with KPMG, is weaknesses within our commissioning, procurement and contract management arrangements. I appreciate KPMG only highlighted around procurement and contracts, but certainly we as officers, we see that as a full cycle, right from commissioning arrangements right through to contract management. So we have picked that up. And then the final one is the Adult Social Care Improvement Plan, which has been developed on the back of the recent CQC inspection. So page 276 to 293 of the report really sets out the compliance against the kind of guidance and regulations that we need to follow and the kind of governance. And it's identified areas where we do meet those requirements, but also in the far right-hand column, it sets out where we think the gaps are. It's really important, I think, for us to be open and honest where we think our gaps are to be able to move forward. And then the final part of the report, really from page 294 onwards, shows the detailed progress against the issues that were reported last year. And then from page 301 to 306 of the report shows the actions that we will be taking against the issues that have been raised in the current year. And the next update will be November. Yeah, and we will be reporting. So what we'll do in November is it is likely, particularly if some of the previous year's issues haven't yet been fully closed off or fully completed adequately, we're likely to continue to report on them. Any of the new ones that are identified, as I say, pages 301 to 306, we will be reporting a progress against the actions that corporate directors have set out. So I'm happy to take any questions. I'm conscious there's an awful lot of detail in there. Just to say, Appendix B is really just for your information. It includes the local code of corporate governance, which I think is best practice for us to include with the annual governance statement. But yeah, happy to take any questions.
It's a governance question that the North London Heat and where I always get it wrong, Waste Authority, the heat and power plant. That's outside of that's under its own governance arrangements, but it appears that that is importing a risk into the council in a delay in the service that we expect, and also an increase in cost. How are the governance arrangements? We need to, as this committee, we need a view on the appropriateness of those governance arrangements and whether they are actually acting effectively at both projects, which is overrunning and delayed and costing more, and that the governance arrangements are correct in and of themselves.
Thank you, Councillor Clark. So as part of the audit plan for this year, there is an audit around two aspects. First is around our understanding of the risks we face with North London Waste Authority. So we have a risk which is at the corporate level, which identifies the risk at sort of a generic level, but actually a more detailed appraisal of what the specific aspects, as you've identified too. There may be others as well, but just to make sure that we've understood those. And off the back of that, there is likely to be another audit, which I've begun, around understanding what the governance framework at the North London Waste Authority is, and its subsidiary and its contractors, because it's quite a complicated governance arrangement they have. So I'm liaising with my equivalent at Camden to try to understand the picture from their point of view, because they are the lead authority of the 7 that use the North London Waste Authority. But off the back of it, I think we would try to get an assurance map of some type to help us understand essentially what governance arrangements they have and how robust they are in trying to manage their operations in the way we want to see.
If you don't mind, if I could just add one point, and you've picked up on the project, so the energy plant. So there will be the formal governance arrangements that are in place at our end internally in terms of working and managing that relationship. But there are also very, very close working now at an officer level in terms of looking at that project and the progress of that project. So that includes myself, that will include the Corporate Director for Environment and Resident Experience, and others. So there is formal arrangements which will get picked up as part of the reviews that Minesh has just highlighted, but there is really close working, close oversight on a more informal basis of that project as well.
Councillor Williams.
Sorry. I think the short answer is no, Councillor Williams, but we'll take your comment away.
Is that one which is that I did read through the code and looked at the individual items that we are supposed to be reporting against, and you can see that we are reporting against those in the report. It is not what I would call a transparent one-to-one mapping. It is complicated and difficult to follow to make sure that we have covered everything off. I also think there is some repetition, and there are other ways in which, well, I found it a difficult read, even having been slightly on the inside. So I would like to suggest that for next year, we look at how we can represent this to be rather more concise, to avoid the repetition, and to be clearer as to how we're making the conclusions that we are meeting the conditions of the code that we're operating under. Yep. The second point is that this is the one item on this agenda which this committee is asked to approve. And we're being asked to approve it after it's been published, which sounds to me a little bit upside down. So I'm wondering if there is a way that the draft governance statement could be made available to an earlier committee meeting, given that we kind of know where it's likely to be going when we're well through the year, so that we could be able to approve this statement before the publication of the accounts. Now, this is likely to become even more complicated, given that the publication date for the draft accounts is going to be put forward to May going forwards. And that would suggest that the March meeting might be a time where we could look at having a draft governance statement for us to consider, accepting that it may change before the year end because circumstances change. So I don't know, can we add that to the list of actions, please, Minesh and Taryn?
Thank you, Chair. And yes, no, we'll take that away and have a look at this. The immediate thought that I had was that the statement is for the end of the financial year. So preparing it before the financial year would automatically mean that it would have to be changed for anything, if anything significant happens in the intervening period, especially when we think about the time lag for preparing the papers and making sure they're published before the audit committee. Nevertheless, look, in terms of the entirety, this is a draft statement. If the committee has any views or anything that would suggest in terms of adding or changes, that can be taken on board before it is finalized as part of the accounting process. So by the time we get to, I think it is January, when the accounts will be finalized, those matters can be captured. So this is still an opportunity for the committee to comment upon the statement as is, and make any suggestions. I think that's what we stand. But I'm still happy to see if we can have a 2 bites of the cherry on this.
Thank you, Minesh. Okay, are there any further questions on this item? Then, Rina.
Just to come in on one, I was having a quick squeeze at the 24-25 governance statement, and one that ostensibly is missing is around workforce. And there's no stipulation in this to clearly say whether that was closed out, resolved, is this no longer a risk, or and I may have missed it in the 450 pages that we had to read, so apologies. Cool. Cheers.
Thank you. So there is a section, I think it's paragraph 3.1, which deals with all the significant governance issues that were raised previously and what's happened to them. I haven't checked myself whether that item's there or not, but you're absolutely right. It has dropped from last year into this year. That's one of those things that actually has been completed or been dealt with. Yeah.
Okay. Thank you, Minesh. So no further questions? So,
I have a few notes that I've made on the documents. Would it be okay if I just pop those through to Minesh and Taryn for maybe future iterations of this document? But the one question I did have was on the managing data line. And I'm looking at the AGS that's in the statement of accounts. That's on page 243. We've spoken about data governance at this audit committee since I've been here. So I expected a gap in the managing data, but I don't see it. And I think from the discussions of previous meetings, there definitely are gaps in how we manage our data.
Thanks, Rina. Fair comment.
Thank you. That's a real good spot, and you're absolutely right. We have discussed this at one of the other meetings. I think the way to deal with this is if we take that back to the service and consider whether this is a significant governance issue or a governance issue. Certainly in my annual report, I refer to record keeping and audit trails as a means of capturing that essentially that point around having good records, good quality data to be able to do some of the things that we do. But I'm happy to send that thought back to colleagues to see if this is a significant governance issue that should be included as part of the AGS for this year.
Thank you, Minesh. Any further questions? In that case, let's move to the recommendation, which is that the audit committee review and approve the draft 25/6 governance statement attached at Appendix A and note the local code of corporate governance attached to Appendix B. We content? Thank you very much. Okay, let's move on now to item 10. Which is your internal audit report. Minesh.
Thank you, Chair. So traditionally at this time of the year, I bring to you my annual report, which essentially is a summary of the audit work that we did for the financial year 25/26. If I spend a couple of minutes just putting some structure to the report and then identify or say a little bit about more about the work that was done and the opinion that follows from that. So the report itself comprises of numerous parts. I'm sure you'd have seen that. And the structure essentially is one where I try to explain the context behind the annual report. So you'll see that in the first part, there is reference to the role of audit and how the work of internal audit is applied through the standards that are relevant to the internal audit service. Then there is the approach. So this really sets out the internal audit strategy and the charter that drive the work of audit in terms of what it is that it audits and then how does it audit those areas. In the exec summary, I set out my opinion, and that is required under the global internal audit standards. I try to give a definition of what that actually means. You may notice that some authorities have a different opinion in terms of how they categorize that. Essentially, that's left to the head of audit to determine. We have 1 of 4 opinions, and I'll talk a little bit about that in a minute. I've also set out the coverage. So what audit work was actually done, what was originally planned and was changed during the year. And that's really for a transparency point of view. So you have full visibility of the work that audit carried out. In the actual report, there is a section that deals in more detail around the responsibilities, and that's important. I am required by the global standards to make sure that I tell you about those, so you have an appreciation and expectation of what I should be bringing to your attention. And then finally, you'll see that I have a section that deals with the analysis. So I've sort of sat back and sort of said, well, okay, well, that's all nice. We've done all the work. What does it actually mean? What is the work of internal audit and other assurance providers, including our external audit colleagues? What does all that actually tell us? So that's the structure. So the key message then. I start by saying that the work that internal audit has done has been compliant with the global standards. It's important for you to know that, because then you have more trust in the work that the auditors have done. I have in my report said that the last time we were reviewed externally, and we are required to do this every 5 years, was in April 2022. So in April 2027, by that time, I will have to go through that cycle again, which will be reported to the committee. That's again important for the committee to be aware of. And at that time, we were found to be fully compliant. I have looked at that, and I think we are still fully compliant. I don't think we've become uncompliant. I have to add just one point though, because the global standards have changed, and I have done a self-assessment of how the old standards and the new standards apply. I think there are some little gaps in some areas where there's new additions to the new standards. So we'll have to fill those. And I've identified those in my something called a QAPE, Quality Assurance and Improvement Plan. And I'll talk to that in a minute. So coming to the opinion, unlike previous years where I have given my opinion in one overall sentence, I've decided to layer my opinion to give the audit committee a greater appreciation of my thinking. And essentially, I've looked at the 3 tenets upon which the work of internal audit and my reporting to the committee is carried out. That's on the basis of the governance of the authority, on the basis of the management of risks in the authority, and the level of internal controls and their application in the authority. And essentially what I've identified, or what my opinion is that in terms of governance and risk management, I think we've got adequate arrangements in place for those areas. Where we have gaps, or where we lack is around the internal control area. And in particular, it's not the design of controls, it's the application of controls, as in we design controls, but actually don't necessarily follow them through. And the basis for me to come to that conclusion, I've set out in various paragraphs. So you'll see that from paragraph 3.13, there are numerous sections that sort of set out the main areas, but I'll just talk through those areas now. You spot that the work we did around housing identified a number of key parts of housing operations not working as well as they should. This is specifically in relation to the audit of housing repairs. This is housing responsive repairs, which was assigned limited assurance, and voids, which was also assigned limited assurance. And we had a presentation at the last audit committee from management in terms of the next steps in that area. There was also some work done around property services, Within the improvement plan, the service seeks to put in place appropriate internal controls around 2028. That's still some time away. And as we heard from our external audit colleagues, the controls are not quite there yet. And so I've considered that in my opinion. On a slight positive there, though, previously I've reported on the audit around acquisitions and disposals as being limited assurance. So I've had some concerns in that area before. I'm pleased to say that actually the audit done last year in that space got a higher level of assurance. So that's pleasing. And that's particularly relevant where we are talking about potentially disposing of assets in the future. The financial challenge is upon us, of course. The authority has put in place numerous arrangements to try to control its cost base. And those arrangements, though they've been established, the application of those is still slightly mixed. So where we've carried out audits around governance with cost control measures and governance over the delivery of savings, the control environment there hasn't been really as robust as it needs to be for us to have a meaningful change in the financial challenge that we face and then the control of those. Adult social care is the next area. Our external audit colleagues identified an area which I'd raised last year around the assessment process and how it is that the service ensures that people who come to us and need our support in delivering some form of social care and are able to pay are assessed quickly and the payment is made. There is a further control issue here, which is the raising of the debt and the collection of debt. That is quite a complex process in the authority, and if we could simplify that, I think we could have quite a difference for people to be able to pay. One of the challenges people face is not necessarily knowing how much they owe at a point in time, and that's due to a process matter. In adult social care, I have also identified the brokerage function as something that needs to improve. So this function it encapsulates the financial assessment team, but it's also responsible for the placement of adult social care needs. At the moment, they're not using all the tools available to them to try to find the most value for money package to deliver to the customer. I think there's opportunities for monies to be saved there. And so I've taken that into account as well in my consideration. We've heard about procurement, so I won't mention procurement, but essentially there is something about how the organizational procurement practice is improved to deliver better value for money. And that starts from commissioning. And I'm pleased, I have said that I'm pleased to see that there is a commissioning board that's been established, which I think will help the organization to understand better what it actually is procuring. I've also considered two further reports. So the internal audit of Homes for Haringey, which is a wholly owned subsidiary, and HCBS, which essentially is another organization where we have an interest. For both of those areas, we've assigned limited assurance overall. So I've considered those in my assessment too. So for all of those reasons, I came to the view that the internal control environment really wasn't where it needed to be at, and therefore assigned an overall opinion of limited assurance. I should say I did some analysis of the audit work that was carried out, and that was about 50-50. So about 28 audits were completed. About 50% of those were assigned a good level of assurance, and about 50% weren't. But I did see that the delivery of savings, and our external audit colleagues have spoken to that already, was assigned a very low level of assurance. Basically, it was a view of internal audit that we would not deliver anything like the savings that we'd planned for last year. Just to finish off on a couple of points, Chair, if I may. So when I thought about what the outcome of all of these audits actually told us. I wanted to crystallize into 2 or 3 key areas of where those internal controls were not as good as they should be. And from my analysis, I came to the following conclusion. I thought that management controls weren't robust enough. By that I mean, it is really important that if we ask our staff to carry out an action, that the level of oversight means that if they deviate, they are sort of brought back to account. That happens, but maybe not as regularly as it should. So I've picked that up from the audit work that's been done. Record keeping and poor audit trails. I've referenced those. In some of the audit areas, actually the records to help us understand what had actually happened wasn't as robust as it should have been. Look, one thing I'd expect government to be really good at is record keeping, and that really wasn't really where it needed to be. So I've raised that as an area where we need to improve. And as a sort of a general point, what I'd call the second line of defense. So these are functions and services that we have that have a dual purpose. But this includes things like procurement, HR, performance management, where essentially they are there to make sure that they are the gatekeepers in making the organization work in the way that the organization should work. So we have performance measures that tell us if we're slipping on certain aspects of our deliverables, or we have HR that make sure that we follow proper HR practices in how we deal with our workforce. That level needs to be strengthened because a lot of things seem to go wrong and past those functions, which they shouldn't really. It should be rare that we have that. The work of internal audit is the third line of defense. And so when I'm looking at audit work, I'm looking at the second line of defense and the management actions in delivering services. I've also referenced the governance issues raised in the AGS, the annual governance statement, and I've referenced some of the work that there's a lot of you can see there's a lot of crossover between the work that internal audit's done, the external audit work, and the self-assessment on the AGS. If I can finally just say something about schools, you'll see that within the appendices that support the annual report, there are references to the work that we've done in schools. For a period now, we've had good levels of assurance at schools. Most of the schools that we've audited have shown good financial control and good arrangements for managing their affairs. Unfortunately, it feels like we are slipping. So for last year, of the 11 schools audited, 7 were assigned a limited level of assurance. None were terrible, so there were no nil assurances, which is pleasing. But I think this is symptomatic of the financial challenges that school might be facing and how they're having to respond as well. So a number of schools were assigned limited assurance, and within my report, I've identified again the principal causes of those, and they tend to be, some are minor in terms of administering, but major in terms of impact. So these are things around declarations of interest, making sure people know what the process is there. And then there are some which are more complex for schools. So around making sure procurement practices are followed and proper governance is established over those. There were some challenges around financial controls too. And so I've referenced that. I think there are a couple of other points, but I think I'll pause there and take any questions.
That seems to be a particularly beneficial area in the sense that it actually leads to money coming in or avoiding money going out, and quite possibly at a level which exceeds the cost of the people who are doing the service that is doing that work.
Thank you, Chair. And those are the words I would have used pretty much. There is a separate agenda item on the fraud paper, so I'll cover the substantive points there. But I think it's true to say that over the last few years, particularly after COVID, and I may have said this at the audit committee previously, it is noticeable that the level of fraud is getting more and more sophisticated and more brazen. So we have a team of 5 people that's trying to manage a number of different aspects in the fraud space. I think, honestly, I think I've got my work cut out here. I think there is a lot to do in the fraud space, but I'll speak to that when I get to the item. But it is absolutely right that in my assessment, I have considered the anti-fraud work activity as well, and that's one of the appendices as part of the pack.
Well, it's a technical question, but when will we have sight of your audit plan for the coming year? And I'm maybe leading the witness here, but that management of voids, homes for Haringey, the audits for those, they the focus of your activities for the coming year.
So the plan is published. My apologies, I should have actually just circulated the plan to the audit committee. At the last audit committee, so the way the cycle works is that before the start of the year, I bring in the audit plan to the committee for committee approval. So there is a plan, and I'll circulate that to the committee members. And by all means, if there's anything that you see that interests you, just contact me.
Okay, recommendations. It would be really useful, I think, for us to be able to monitor them. So do we have a list of all the recommendations and of the time scale of when they expect to be done and whether they're like a kind of RAG rated list as to whether they're doing them? And could we, I don't know whether we have the list, and so that we consider it at every meeting, we just are able to glance through where the recommendations are and note that report. So a bit like, remember on FRAC in Homes for Haringey, remember we were tracking the recommendations, so doing something similar.
Thank you. That's a good question. I have got a list of all of the outstanding recommendations from previous year. In fact, in my report, I think I referenced those too. I'm happy to bring a summary to this committee every meeting just to sort of say, well, here are the. I think we should focus on priority 1 recommendations, because if we go to all the recommendations, there's going to be just far too many. So if we look at the P1 recommendations, and I'll just bring that to the committee.
Thank you. Are there other questions? Councillor Fitzgerald.
There was a question I had about Appendix 2, Internal Audit Service Improvement Plan. I noticed mention of the audit service that we have with Croydon. It says that the current contract expired in March 2026. Are we still waiting for a new contract? And if that isn't sorted yet, how is that going to affect, your ability to carry on providing the assurance we need for the rest of the year?
Thank you, Councillor. You could probably see the scars at the back of my shirt there. So yes, the contract has expired. We are going to get a new contract in place. That contract will start from the 1st of October. In the meantime, though, as you quite rightly say, we can't do without an audit function. So there is a temporary arrangement that we've made through procurement for the continuation of audit work. So that's happening. But I will put in place a more robust contract arrangement from the 1st of October for 3 years after that. So that should carry on with any luck.
Are there other questions? I've got a couple for you, Minesh. One which is, I recognise that the plan was approved by the March committee meeting. However, with circumstances have changed a little in review of the receipt of the statutory recommendation, and I'm kind of wondering what level of in-flight corrections there may have been to the plan to reflect that. I'll leave you with that one for.
Thank you, Chair. So, look, the plan is never really fixed. New risks materialise, new activities come to light. And so organisationally, I'm always keeping abreast of the plan and then updating it. So what you'll see that in my annual report, there's a section that deals with the original plan and why some audits were not taken forward, and then in other audit areas added to the plan. So it's not atypical for changes to be made, and that's what I mean in terms of, I appreciate that this is a new committee. You may have a different view on the audit areas, so I'll share the plan, but I also have to, as you quite rightly suggest, I also have to review the plan myself to recognize the new areas of risk and to change the plan accordingly.
Thank you, Minesh. And the second question is, when you're looking at the overall opinion and all the audit work which is being carried out, it's great that we've got the conclusions that we do have. The other aspect which springs to mind is, what proportion of the council have we actually covered during the current year? Because if we've covered 5%, then the conclusion has a certain weight. If it's 50%, it's a very different weight. And similarly, over how many years would it take us to be able to say we have covered, the council or substantially all of the council?
That's an interesting prism to look through. So the way the global standards are designed, and this is how our strategy is set out, is that essentially the plan is risk-based. So what that means is that organizationally, wherever there is an area of risk, the work of internal audit should help inform by providing assurance that those risks are being managed. So there are going to be some areas of council operations where audit is not going to have too much of an input, because they will never materialize as high areas of risk and therefore no need for any assurance. Having said that, though, I'm slightly old-fashioned, so that means I always keep back a small number of days to focus on any audit work that we haven't done in an area for a long time. I'll give you an example. We have a centre in Wales, Pendarren. That's not really a very high-risk area usually, but I will audit that every 5 years, just to keep sort of a watching brief. So I suppose in a long-winded way, my answer to your question would be that the work of audit really focused on the high areas of risk as identified last year. And on the basis of that, the internal control environment was not as robust as it could have been. That's not to say it was terrible, but there are improvements that could be made. This year's plan would be similarly diagnosed. But the comfort that the audit committee should have is that the work that I do, and actually colleagues from external audit and the other agencies that carry out a sort of their assessment of the council, essentially give us a very good view of council operations and where we stand. Sorry, I hope that sort of answers the question.
But it would pardon?
I hope that sort of answers the question in a roundabout way.
I mean, it's partly answered the question. I'd still like to wrap my mind a little bit around how we can look at that question of coverage, because comfort actually is in part derived upon extent and scale as well as the focus. And risk focus is absolutely right, because you don't want to be just looking at the easy areas, but it is also nice to get a feel for how that coverage is being achieved over time. You don't have to give me an answer now. I think that's something which we perhaps think about in between. Yeah. Any further questions? Okay. The recommendation is that the audit committee notes the contents of the head of audit and risk management's annual audit report and the assurance statement for 25-26 and the accompanying appendices. Are we content? Thank you. Let's move on to item 11. This is the Treasury report. So I'll hand over to Sam and Jamie. So we did last week everyone here happy with section 3. One. Section 3 gets so first statement, state one, comparison to our excellent balance sheet, comparison of capital financing requirement and main points to note on use on this table is the expenditure around it. That borrowing is principally driven by our accounting scheme. Very ambitious. And also tied up in that is our EFS for our income and expenditure. Table 2 that goes on to so table splits out long-term short term borrowing. It gives us just one issue the borrow for months. See that you didn't know the amount of disease. It's and also now it's the money needed to invest in expense. So far, we started the year with 75 and we reduced it as into 70 million. In the year, we started with 30.6 billion for cash equivalents, and end of the year, it's 1. That makes it like a swing, but really this is just we're borrowing in preparations and seeing which should be into more. So even though we're not 27, may say before that might be used slightly to have already and we even though including finding models of seen in one third one very see very one response in even if it Are there any questions so far? Any questions so far? Councillor Carlin.
It's not really a question, but it would be maybe useful for us to break down what borrowing is on the general fund and what borrowing is on the HRA. Because obviously that's just in terms of, borrowing for the council house building program where each scheme is going to wash its own face and where we're adding assets, etc., is very different from borrowing, kind of dead borrowing, EFS, or money that we're not going to get back and we're just going to have to pay off. So yeah, so it would, and also we borrow differently because one we're borrowing repayment and one we're only borrowing interest only. So I think breaking it down would actually be useful in the tables.
Basis point. So I need to do that analysis. We have to be sure that
So what I was saying is that it would be useful when we're reporting in these reports to actually have that breakdown in the report.
yes. So table 3 then takes us on to further breakdown of our borrowing position. So at the beginning of the year, we had 806 million in borrowing the public works and loan board, 100 million on logos. Yeah, and then we had 75 million on local authorities. Logos on the CP bad products that were sold to local authorities in the 80s and 90s. The idea behind the logo was endless option borrow options. But in reality, it was a reason for endless options. And those loans essentially always end up being very expensive. So we have very much want to reduce our exposure to those. So over the year, we were able to negotiate repayment of 50 million pounds worth of logo and bar. Those loans had a market value of 57 million. So that's significant savings for the council. We have reduced also our dependency on local authority borrowing. Local authority borrowing is typically over the short term. Given the high volatile nature of bonds, having a lot of borrowing advantages on the short term essentially has a massive amount of refinancing risk. So we try to take that on the table with a lot of bonds that borrow. So on page 4, we're very on to the we have a breakdown of our we have one program maturity structure of our borrowing, but we also have a table further down. And then so 75 bits of long-term investment. The super trading command portfolio asks us to prioritize security, liquidity, and then yield. So those are our principal concerns. So saving money, the ability to access the money at quick notice, then yield that our large concern. And at the beginning of the year, we started with 13.6 million pounds worth of money market fund investments. And as to previously,
So, further treasury management strategy statement, we should maintain £30 million of open accounts and modern times. So the the 13.6 million represents the breach, and we breach to 18. It would be that last year. Yeah. So but that breach was involved in bigger rounds. So we didn't spread anything like payroll or ability to pay our accounts payable. So table 6, the next is on our investment benchmarking. So the first 2 lines are the credit scores of Harrogate Council and rates of return that we've been getting on our investments. Does everyone understand what Bailey exposure means? Yep. Yep. And then section 6 takes us on to the so the table 7 represents the cost of borrowing and the income generated by the investment of our surplus funds over the year. So we note we came in slightly lower than our budgeted figures, and it's primarily because the capital scheme to compress and the speed well. I mean, this is a typical cost of local authority. Often the capital schemes don't invest as far as quickly as we like to, and so it's also been nice to put less money than we get reasonably well. And then the next key section of this will be development plans. So this is comparison to our credential independence. So per the treasury management strategy, there's the whole list of credential independence level. The treasury management requires us to so table 8 shows us, so there are 2 boundaries. So first we have the implied limit, which is your intermediate standard limit, so that you are required to such a boundary. And then the operation boundary being a operation boundary being a unit set by the council that gives us that first one that we get close to reaching that in the play. So the borrowing, the urban borrowing, the client should be applied requirements when you set prior to our understanding of the implications of IFRS 16. So the authorized unit operation boundary set inappropriate that has been addressed this year, and so we don't expect us to be breached, and even to the technical breach, in reality, I'd like to think. And then section 9 takes us on to the range of our credentialing. So we've got the average credit score for our investments, the average liquidity that we should maintain, our interest rate exposure. So that is sensitive. So this is the what happened with the opposite 1% minus 1% 14 interest rates. And then, perhaps we can have rates. And then last statement here is the maturity structure quality. So we have options as to how much of our social debt would be within those duration as how you master us to make monetary value. So we did that for that table. So I think that helps a bit more. Yeah, that would bring us again.
The rates on PWLB see that are significantly different, increased. They look quite a lot higher than they were last year, 0.5%. Is that expected? Would you look to play with the distribution of the structure of borrowing and the maturity terms to try and reduce the cost of borrowing, given that cost of borrowing in and of itself is a source of borrowing for the situation that we're in?
So last year or so, we've been borrowing on the 10-year EDR. That's one thing great. And our research lines yeah, so this is something that we don't just select really maturity and that's it's a constant evaluation.
I suppose my question is the strategy shifting in response to
Yeah.
So the treasury management indicators are looking good. They've got compliance across all the indicators. I'm just wondering which of those indicators you feel are of most concern in terms of complying next year and in future years.
Are there other questions? Yeah, Riaz.
Thanks, Chair. Just on the indicators as well, for the leases, I know you mentioned the accounting standard caused the boundary to be a bit wonky. So, and you said it's corrected in the current year. So what is the current operational boundary and authorized limit for the PFI and finance lease? Yeah. Yeah, I just want to figure out how close we are to it, if at all. I just wanted to get an idea how close we are. And then just one more question, if I may. Again, on the indicators for the liquidity, I know you mentioned that we moved, there's quite a big movement between 2025 and 2026. And you said it's, if I remember correctly, you said it's because we took out additional borrowing closer to the end of the year. Is that right?
Yeah.
Yeah.
So, you know, we more
Sure.
the next one. And that's,
If we hadn't, would we have breached the target? The 30 million target?
so sorry. So at the end of the year, before we had basically
Correct.
back is the breach that we considered 13 million. So there's huge amounts of capital was that were made in the last study, which terminal broke down to be aware that was needed. We went below that 30 million minus less than 24.
Yeah, I remember that from the last meeting. What I'm saying is I'm trying to get to the point that we didn't borrow to meet that target. That's the answer I'm looking for. Sure.
Sam, I have a question about the boundary. The ones we've got here, operational boundaries, are all balance sheet based. Do we ever look at the income statement side, and therefore what is the sort of maximum amount of interest expense that the council can safely experience, recognizing that some of that interest expense may be related to the building and buying houses, which have an asset backing and also an income stream associated with them? And are there any benchmarks which are found elsewhere that might give an indicator to that safe level of interest expense? I'm just kind of wondering if we're looking at other ways of being able to manage our costs and look for savings, that that might be something else which is worth throwing into the mix.
Yeah, let's take that away and we'll consider that for the future, like the reports that come forward in the future.
Are there any other questions? Okay. Our recommendation is that we, first of all, to note the Treasury management activity undertaken during the financial year to 31st of March 2026 and to performance achieved, which is shown in Appendix 1, and to note that all Treasury activities were undertaken in line with the approved Treasury management strategy. Are we content? Thank you. Closing thoughts, Sam, I believe this is going to be your last committee meeting. So I would like to say thank you on behalf of the committee for all of the work that you've done in your treasury position for the last 18 months or so. Thank you very much indeed. Thank you. Thank you both. Okay, move on to item 12, which is the risk matrix. And I will pass across to Minesh. We have this, slightly more readable.
Thank you, Chair, and that thanks goes to Naz for printing those off. So look, just a quick update on the risk management paper. I bring this paper to the audit committee so that as part of your remit, you get assurance that management is looking at the corporate risks rather, and is taking action where appropriate to manage those risks. The last refresh of the corporate risk register was in April 2026. My apologies, I've noted that I've said 2025 in my report. It is actually 2026. And the risk register, the corporate risk register, has 17 risks. 8 of those are on the scale where they need attention. So they're in the red bit. And of those 8, 3 are in the extreme red bit, where the highest impact and likelihood are shown. So what that means is that we have a 5 by 5 scale. And so for 3 risks, we've got a score of 25. 9 other risks are in the amber region, where they need monitoring and managing. And 3 of those I identify for you as having the highest impact, but the likelihood is shown as being manageable. And the reason I highlight those 3 is because if the likelihood is slightly more than we've anticipated, they go into the red bit as well. The profile of the risk register or the risks is shown at paragraph 6.2. And the most significant risks that I'd like to bring to your attention is the one around the risk that we don't come off the ESF and we are overly reliant on ESF in the medium term. Then we have risk number 14, which is around the financial risks from the significant overspend at the North London Waste Authority. And risk number 10, which is around building control. And this risk was in respect of the service not having enough manpower to be able to do its work. CLT have considered this risk and have asked for it to be managed at a directorate level, so that will not feature on the corporate risk register for next time. And you can see that actually in the grand scheme of things, the other 2 risks are much more significant than the building control risk, so that makes sense. The other risks which are worth noting, I think, for the audit committee are risk number 2, which is around the non-delivery of savings. Risk 12, inability to attract and retain staff. Risk 9, failure to prepare for the impact associated with climate change. And risk number 18, potential exposure to asbestos, which came to light at the last refresh. One risk that has dropped off the risk register is number 17. Sorry, my apologies again. That should have been, you'll see that in my paper, I've referred that as 15, but it's actually 17, relating to the election risk. The elections have happened and that risk was well managed. Chair, if I can pause there and just take any questions.
I just wondered what we actually do about it. So, for example, building control, we know that this is a huge risk. If we don't have the staff, the Tottenham Hotspur events can't go ahead. We're already ended up, the council itself, projects such as schools, having to actually use outside building control at huge cost, and then they went under. But my understanding is that they asked for a market supplement and it was refused. So I don't know if that's true, but what is the organization when we put something on the risk register? What then does that actually trigger? Because this is a huge, this is highest risk, most likely probability. And what's the corporate, at corporate level, what is the corporate team doing with the risk register in terms of actually trying to resolve some of these issues?
Right, I'll go first. So with any risk management process, the identification and the assessment of where the risk lies is the first stage, leading to then consideration of what more can be done. Though the building control risk is very high, due to staffing. Actually, organizationally, this is a much broader issue. It's not just building control. The same can be applied or can be said for other services who are experiencing quite severe stress from lack of staff. So there is a corporate initiative to try to improve the retention and the attraction of coming to work for Haringey, and that should hopefully allow building control to be able to manage its affairs. But I think, in my view, having sort of building control isolated as the service that needs this most is probably not helpful from a sort of a corporate level point of view, because a lot of other risks, other services are facing the same sort of risk as well. Does that help, or are complicated things?
So in effect, what you're saying is that there's a cascade of risks that one of them is actually making another one for even worse.
I think what I'm saying is that there is a generality here, that actually this risk is captured in another way in another risk, which means that actually organizationally, the response needs to be proportionate across the organization.
Yeah, so two things to come back on. So in terms of the building control risk specifically, so we know there is an extreme shortage of people trained in this area. And Councillor Carlin, you did raise around market supplement. We continue to do that work to look at our competitiveness and salaries. And I can honestly say that we discuss it quite often at the statutory officers group. So we are looking at those options, but we absolutely recognise it is a real challenge in terms of attracting those skills, but they are essential for so many of our services, including our house building programme and everything that we're trying to do in that space. So that's on that particular one. But I think I just wanted to come back on your broader question about kind of what are we doing about the risks more generally in terms of managing them. So for over a year now, I think this has been in place. So CLT have a dedicated risk session it's not quite the whole agenda, but it's a very large proportion of the agenda at least once a quarter, where we go through each of the risks on the risk register, look at where we are, look at any movements, is there anything that has changed as a result. We can always strengthen this, and I'm not going to sit here and say it's perfect, but looking at are any of the mitigations that we've said what we do, are they having an impact? So we do have that dedicated conversation now at CLT. What we also do in that session is also just it's an opportunity for directors or corporate directors to highlight any particular risks on their own departmental risk registers that they are concerned with, that they want to perhaps escalate up, have a conversation. It could be that some of those need to go on the corporate risk register, and so those conversations do happen every quarter now. So yeah.
I guess just to follow up on the councillor's question, I mean, the purpose of this document is twofold, right? To identify the worst case scenario, what we've done in place to avoid that, and then what's left to do. And I worry for this particular new risk, the what's left to do part is a bit light, if I can be blunt, and mainly because we're not so far from the worst case scenario in terms of how we've rated this risk ourselves. So I think that there's a lot more work that needs to be done in what the future mitigations actually look like, to get us to a point where we can bring this residual risk down.
Minesh, before you answer that, I think it might be linked, because my observation is that actually some of the risks that we have on this matrix are no longer a risk, but they are a reality, and therefore should be built into what's happening on a day-to-day basis. And the risk then morphs from being what are the actions and what is the risk itself to the risk that those actions fail, and therefore we find ourselves back at square one. I think they're linked, but Minesh, perhaps you'd like to comment as to how we might be able to address that particular question.
Thank you, Chair. And yes, so the nature of some of these risks are that they are becoming more of an issue. So one of the things that was discussed at the last COT meeting was how we could present for some risks, particularly the financial one, a pictorial representation of what could make that risk happen. So essentially the triggers that will crystallize that risk. And that would allow a more focus on what it is that we need to do to prevent those triggers from happening. And then on the other side, thinking about the consequences. So if the risk does materialize, what is it that we need to be prepared for in terms of doing straight away as next steps? So that work is underway, and I'm happy to bring that to the committee if that would be helpful. In a technical phrase, or in the risk management phrase, they call this a bow tie because it looks like a bow tie. You've got a risk in the middle and you've got triggers here and the consequences on this side. So it's a real nice pictorial representation of what are the significant matters. But I think the point that was raised, which is that actually some of these risks might be reality, they're actually issues, is a valid one. And what that would normally mean is that we need to act on those risks or those issues straight away and consider what other risks flow from the reality that's in front of us.
Yes, just building on that kind of concept of the bow tie analysis, I think when looking at the sort of mitigations, trying to segregate what's being preventative versus reactive would be really helpful. So in the context of the cyber security one, for example, you've got it was like mandatory training on cyber security awareness in brackets, not mandatory. So is it mandatory or is it not mandatory? And you know, and it's a kind of cultural thing, because then when you look at it, actually you're doing these phishing simulations conducted by IT, and a proportion of staff are still falling for it. So it's trying to connect up the dots. And then I also noted on that particular one, and I pick on that one just because it's been, quite I know TfL have had cybersecurity attacks, M&S, so these are all household names. So we're certainly not immune from them. It was just around the monitoring tools. I see that the tool, the license that you have expires in December 26. So what is the plan to have something in place? Because of course it takes time to secure the right product and the right tool for these things. So the narrative is helpful, but it doesn't give the visibility and that kind of detailed timetable as to when certain actions are going to take place.
Thank you. That's really good questions. So it is mandatory to do the cyber training. I think the service has struggled to make sure that everyone does it, and that's something that has to be enforced by the organisation. So, but the requirement to do those sorts of training courses is mandatory. A lot of work goes on behind the scenes. You're absolutely right. Look, lots of organisations have been attacked and unfortunately have succumbed to these attacks, and we are not immune. I think I've reported previously that one or two of our schools have been attacked too, and it has been painful. It's not pleasant at all. So we need to be absolutely mindful of these risks. The license point and whether the arrangements are in place, as I understand it, the arrangements are being put in now, but I'll take that away and ask the service just to respond to the committee on that as well. Yeah.
And note the asbestos risk. What other kind of invasive species led other risks to health or risks of statutory, they come with a specific legal obligation to resolve that risk. Are those also on the risk? I can't find, not only here, but are those being tracked across the council's activities? Because things like Japanese knotweed, the obligation is actually on the property owner.
Yes. So I should have said this earlier. This risk register is not the only risk register that exists. So this is essentially this is the organisation's view of what are the most significant risks that we need to manage. And so they are highlighted to the corporate body for them to act. There are risk registers at directorate levels and at sort of functional levels. So for example, there is a cyber risk register, which the cyber colleagues maintain. And within those, they will have some of the things that you've just raised, Councillor Clark, in terms of health and safety or statutory risks.
So those types of the concern that, well, that asbestos was not one of the main risks on the risk register until recently is given the amount of the property portfolio, other similar things. That's where the root of my question was from. If I may, Chair, as well, the exposure to the North London Waste Authority issue, I know that the risk is basically unmanaged in the risk register, even with mitigations. What you know, further, what are the mitigating actions that we as a council are going to take that's pretty light in this document?
Yeah, I'm happy to come in on this one because quite close to the detail. So we have put it on the risk register. So this is specifically around the energy plants that is being developed rather than kind of NLWA more generally. There is and I also highlighted it actually as a risk in the budget report back in March. So we haven't quantified the financial impact, but we have captured it here. I think it was last quarter, wasn't it? This isn't the first time we've seen it. Yeah, it was last quarter. So in terms of what we are mitigating, and it almost picks up on the previous question, it was under, I think it was under your head of internal audit report. So we are looking at kind of the more formal governance arrangements that we've got in terms of that oversight and how we, it is a project that is unlikely to complete until at least 2031. So, you know, it's a risk that we are managing. We're managing at the moment through that ongoing dialogue as we work through the particular challenges at the moment. But I think I've been asked a separate question around kind of what we think the financial liability is. We don't know at the moment, but we are, you know, I suppose the mitigation that we're doing is that we're making sure that we've got those strong relationships at both an officer and a member level with NLWA so that we are fully sighted on that particular risk and that particular project.
Okay, can I just observe that this is not the first time that North London Waste Authority has cropped up in the discussions tonight, and it does seem to weigh heavily on our people's minds. I think rightly so, given the level of uncertainty. You did say that you had an upcoming audit project, and I kind of wondered if it might be helpful to the members of the committee if you could circulate a draft of the project outline when it is available. Yeah.
Happy to do that, Chair. Yeah, absolutely fine. Yeah.
Sure, thank you.
Chair, if I may as well, just in terms of the analysis of the risk, there's a kind of theme that runs through across the risk register, which is that the consequential lack, there is a risk to the council of a lack of service provision that is increasing, making the financial situation worse. Building control, we can't complete projects, which means we've got deferred income. North London Waste Authority, it's not completing on time. It increases. There is almost a risk being generated by the risk itself that we need to, I think, have a focus on across the way that these risks are managed and mitigated, because if we can't complete the housing projects, we can't get the return, and that's driven by building control. There is a kind of across all of the register. There's that element there that I think it would be useful for us as a committee to have a focus on.
That's a really good suggestion. I was just, as you were saying, I was just trying to think of how I could link these risks, because actually you're right. Risks, as they're shown on the risk register, they appear as if they're isolated, but actually the crystallization of one risk means that other risks become more likely to happen potentially. So the impact on the financial risk, yeah, absolutely, it could increase if any of the other risks materialize. how I show that on a risk register is something I just need to ponder on. But you're absolutely right.
I run my own risk registers. I don't think that's a task too far. It's more of a kind of something that
Just
we
linking
need
the
to
risk.
think about in
Yeah.
the discussions.
If you've got ideas or suggestions that can help us and share us to make things better, we'd love to hear them. Councillor Carlin.
I mean, that's kind of why I was asking about whether this is being dealt with at a strategic level. And that's why I'm saying at a kind of CLT level, because they're not just things that happen within a service. This has a strategic implication. North London Waste Authority is slightly different because it's a separate organisation. And the risk there is not to do with lack of resources, it's to do with a whole lot of other things. But certainly in terms of strategically how and the importance of having the medium-term financial outlook as opposed to an annual financial outlook actually should be partly because we need to be managing things like resources strategically so that it doesn't create further risk. And when they start popping up on the risk register as well as a risk, then that just highlights more for the organization. And that's why I'm wondering whether it should be dealt with at more of a kind of CLT level. And Torrance is, you're looking at it, but on a quarterly basis. But I don't know whether whether the risk register to us shouldn't just be producing the risk register, but also as we're the committee that looks at risk, we're an audit and risk committee, whether we should be whether there should be what are the outcomes that we're looking at, what are the solutions that we're looking at, which is what we've been pointing out this evening, that that we then ask as the committee that CLT responds with what is actually going to be done to address these risks, as opposed to their risks. And why I'm saying at CLT level is because it's strategic. It's not just operational. It's a more strategic kind of overview of how to deal with them.
Thank you, Councillor Carlin. So look, as a committee, if there's a risk here that you wish to get further explanations on, I think that's well within your remit to ask the service to give you that, and if need be, you could even invite people to attend the committee to speak to the committee on those risk areas. So that's well within the remit of the committee.
Right. Do we have any further questions? Riaz.
Thanks, Chair. The conversation made me think a bit about linkage again. And it's merely a request when we report on the risk register. So bringing in the conclusions from internal audit and external audit into this report and how they move the dial, whether up or down. So for example, we've got the statutory recommendations, we've got commentary in this report of how that's impacted the financial sustainability risk. One of the reports where we have limited assurance, which was the cyber insider threat one, that hadn't really moved the dial on this. And I would have thought that would increase the likelihood of an incident. And then similarly for the other discussions. So not all of the audit work would sit on the corporate register, but I would like to see some commentary that the results of those audits have impacted the director's service line risk registers.
Can I ask the committee to agree to suspend Standing Order 18 in order to conclude the meeting after 10 p.m, please?
Agreed.
Thank you.
Thank you, Riaz. Yeah, look, I think you're right. So if we are saying in the risk register that we are relying on certain controls which are not effective, then that automatically should up the dial on the risk significance. I'll tell you what I'll do is I'll try to map the risks with the audit work and the external audit work as part of the refresh which is happening now, because this risk register is as of April. So all of the things that we're now aware of should be captured as part of that. And I'll try to map that so that we've got a sort of a trail of how we've got to those and make sure that we're not missing anything. That's a good call.
'25, 26, attached as Appendix A. Yep, agreed. Thank you. Move on to item 13, which is our last item, which is the anti-fraud, bribery and corruption progress report for Q4. We've already covered the annual report. Minesh, if we could be quick as to how many, any highlights or salient features you would like us to look at in relation to this. Thank you.
Thank you, Chair. So I'll be quick on this. I think as the Chair's alluded to, we've covered a lot of the work that the anti-fraud team does, and it more than washes its face in terms of what it's able to do. More important than financials, perhaps even more important than financials, is the fact that people should trust Haringey and what Haringey does to do the right thing. And I think the work that the anti-fraud team does in that space is so crucial. We hear about sort of the fairness or the unfairness of how decisions are made around the letting, where people might complain that actually there was some sort of bias attached. The fraud team will investigate that and give confidence that actually that is not the case and things were done in the way they should have been. So what this report essentially does is that it highlights all of the proactive and the reactive work that the team has been carrying out. And I must admit, when the report's pulled together, it's amazing how varied the different aspects are. So we've got some proactive exercise on temporary accommodation. That's to make sure that the temporary accommodation is being used for the purpose intended. In that exercise, I think there were 24 units identified where there was some anomaly, not necessarily fraud, but just some anomaly in who was residing at those units. So they were brought back to proper use. There's some work on blue badge fraud, the National Fraud Initiative, procurement activity, squatting, where we've got some vacant properties, and housing itself around the use of our let properties and the right to buy. I'll pause there and take any questions, Chair.
Do we have any questions on this report? Okay, but a comment, if I may. I did like the rolling casework charts, and I thought those could be usefully added for other areas. And do we publicise the results of the work to act as a further deterrent if it's known that actually we are detecting people who are perpetrating XYZ fraud? In that case, can I move to the recommendation, which is the audit committee has recommended to note the activities of the team during Q4? So moved. Thank you. And I think I will now draw the meeting to a close. Thank you all for your attention throughout the extended meeting, and also with the extended agenda papers, which I'm reliably told is not going to be the standard. It will be a smaller pack next time. Thank you very much indeed.